Hello, everyone, and welcome back for another deep dive into Mark Douglas's Trading in the Zone. Today, we're going to be tackling Chapter 7, The Trader's Edge, Thinking in Probabilities. Now, we know you're probably already familiar with the book, so we're going to kind of go a little bit beyond the basics here. This chapter really gets at something that I think can trip a lot of traders up, which is how to stay consistent in a market that often feels anything but consistent.
Yeah, it's a fascinating challenge, isn't it? And Douglas uses a really unexpected analogy to help us kind of wrap our heads around it. Casinos.
Casinos, okay, I'm intrigued. What's the connection?
Well, think about it. Casinos thrive on games of chance, where the outcomes are seemingly random, and yet they consistently generate profits. How? It's not magic, it's math. They've mastered the concept of edge, and they leverage the power of large sample sizes.
So it's not about winning every hand of blackjack or every spin of the roulette wheel. It's about having a slight advantage. That plays out over thousands, even millions of bets.
Exactly. Take blackjack, for example. The house edge is often around 4.5%. That might seem small. But over millions of hands dealt, it creates predictable profits. Regardless of individual wins or losses, Douglas argues that traders need to adopt this same mindset.
Interesting. So how do we apply this casino mindset to the stock market, where things feel a lot less predictable than a game of cards?
Yeah, that's where the concept of 2 layers of belief comes in. On a micro level, each individual trade is inherently uncertain. We can analyze charts, study indicators, but we can't truly predict what the market will do next. Yet on a macro level, we need to trust that over many trades. A well-defined edge or advantage will lead to consistent wins.
That sounds almost like a paradox, embracing uncertainty in the short term, while trusting in a pattern over the long term. How do we reconcile those two seemingly conflicting ideas?
It all comes down to probability. Think of flipping a coin. You can't predict whether any single flip will be heads or tails, but flip that coin 1,000 times, and you can be pretty sure the results will be close to 50-50. Trading is similar. We're not trying to guess the outcome of each individual trade. We're developing a system, our edge, and letting the probabilities play out over a large sample size.
Okay, so we need to detach from the outcome of each individual trade, just like a casino doesn't sweat over a single hand of blackjack. But here's where things get a little bit tricky, right? Douglas also emphasizes that every moment in the market is unique.
That's right. Even if we see a chart pattern, that looks identical to one we've seen before. The underlying market conditions are constantly changing, so we can't rely solely on past experiences to predict the future.
So experience is helpful, but it's not a crystal ball. And this brings us to something I think a lot of traders struggle with: unrealistic expectations. We get fixated on a specific outcome, and it can blind us to what's actually happening in the market.
Absolutely. Douglas calls this our pain avoidance mechanism. When we're emotionally attached to being right, our brains can literally filter out information that contradicts our desired outcome.
It's like we're subconsciously trying to protect ourselves from the pain of being wrong, but it ends up sabotaging our trading in the process. So how do we break free from this trap? How do we develop more realistic expectations?
Douglas offers a solution that I think is really powerful. Be rigid in your rules, but flexible in your expectations. Have clear trading rules based on your system, but be open to the endless possibilities of the market. You're not trying to control the market. You're trying to align yourself with it.
So stick to the plan.
Yeah.
But don't get fixated on any one outcome. That makes sense, but it sounds easier said than done. How do we actually start thinking in probabilities in a way that impacts our trading decisions?
Well, Douglas outlines 5 fundamental truths that help us develop a probabilistic mindset. They're all pretty straightforward, but they're worth revisiting because they form the foundation of his approach.
Okay, let's hear them. What's the first truth?
The first one is anything can happen.
Right, that one's pretty self-explanatory. The market can move in any direction at any time. What's the second truth?
The second truth is you don't need to know what's going to happen next to make money.
Okay, so we don't need to be fortune tellers or have some secret system for predicting the future to be successful.
Not at all. Truth number 3 is wins and losses are randomly distributed even with an edge.
That one's a bit harder to swallow. So even with a solid strategy, we're not going to win every trade.
Exactly. And truth number 4 builds on that. An edge just means a higher probability of success, not a guarantee.
So we can tilt the odds in our favor with our analysis and our system, but we can't control the outcome of every trade.
Precisely. And finally, truth number 5 brings us back to a point we discussed earlier. Every moment is unique.
Right. So even if we see a pattern that seems familiar, we can't assume it will play out exactly the same way every time.
Exactly. These 5 truths are the foundation of a probabilistic mindset. But how do we translate these somewhat abstract concepts into concrete actions in our trading? That's the key question, isn't it?
Yeah.
Yeah, that's where the real work begins. It's not enough to just understand these truths intellectually. We need to internalize them, let them sink into our subconscious minds, and actually guide our trading behavior.
Okay, that makes sense. But how do we bridge that gap between intellectual understanding and actual implementation? How do we go from knowing these truths to living them in our trading?
One of the most powerful ways is to shift our focus from outcomes to process. Instead of obsessing over whether each individual trade will be a winner or a loser, we focus on consistently executing our trading plan, our system, with discipline and precision.
So it's about trusting the process, trusting our edge, even when the short-term results are unpredictable.
Exactly. This can be incredibly challenging because as humans, we're wired for instant gratification. We want to see results now, and trading often doesn't work that way. It's more like planting a seed. We need to nurture it, give it time to grow, knowing that we can't control the weather or guarantee a bountiful harvest.
I love that analogy. It highlights the importance of patience and trust in the process. And just like a gardener learns to accept the occasional bad crop, we need to learn to accept losses as an inevitable part of the trading journey.
That's a key point. Embracing those 5 fundamental truths means accepting that losses are not failures. They're simply part of the game. They're data points, providing us with valuable feedback that we can use to refine our strategy and improve our edge.
That reframing is really helpful. It takes the emotional sting out of losses.
Yeah.
And it helps us view them more objectively.
Exactly. And this leads to another important step in developing a probabilistic mindset. Embracing risk as a necessary element of trading.
So it's not about avoiding risk altogether. It's about understanding it, managing it effectively.
Absolutely. And this starts with the principle we discussed earlier. Predefining our risk on every single trade.
Right. By setting our stop-loss levels in advance, we're essentially saying, okay, I'm willing to bet this much on this trade, but no more. It's like setting a boundary to protect ourselves.
That's a great way to think about it. It takes the emotion out of the decision-making process. Because we've already made the decision about our maximum risk before we even enter the trade. This allows us to act rationally, even when the market is moving against us.
It's like we're taking a calculated gamble, knowing that we can't control the outcome, but we can control our exposure. This ties into the idea of detaching our ego from the outcome of each individual trade, doesn't it?
Absolutely. We need to view wins and losses, not as personal victories or defeats, but as data points in a larger statistical game. Each trade is simply an experiment, giving us information that helps us refine our edge.
It's like we're scientists, conducting experiments in a live market laboratory. We analyze the data, adjust our hypothesis, and keep experimenting.
I like that analogy. And just as a scientist doesn't give up on an experiment after a single failed trial, we shouldn't abandon our trading strategy after a few losing trades.
It's about perseverance, resilience, and having faith in the process over the long term.
Exactly. Trading is a marathon, not a sprint. And this brings us back to another point Douglas emphasizes, the importance of focusing on the present moment.
Right. Being fully present with each trade, making decisions based on the current market conditions, not dwelling on past losses or worrying about future outcomes.
It's easy to get caught up in those mental traps, but the only trade that truly matters is the one right in front of us. We can't control what happened in the past, and we can't predict what will happen in the future.
This is so powerful. By focusing on the present moment, the process of executing our plan with discipline, we're essentially reclaiming our power. We're focusing on the one thing we can actually influence, our own behavior.
You've got it. And that's the essence of thinking in probabilities. It's about letting go of the illusion of control and embracing the inherent uncertainty of the market.
So we're not trying to force the market to do what we want. We're trying to align ourselves with its natural flow, its probabilistic nature.
Exactly. And that alignment starts with accepting that the market is always right, even when it doesn't seem to make sense to us.
There's a certain humility in that, isn't there? Acknowledging that we don't have all the answers, and that the market has a wisdom of its own.
It's a crucial mindset shift. That humility allows us to learn from our mistakes, rather than beating ourselves up over them. We transform setbacks into valuable lessons that help us grow as traders.
It sounds like we're shifting from a fear-based mindset, where we're constantly trying to predict and control, to a growth-based mindset, where we embrace uncertainty as an opportunity for learning and evolution.
That's a fantastic way to frame it. And this shift in mindset is the key to unlocking our true potential as traders.
So by embracing uncertainty, focusing on the process, and detaching our ego from the outcome, We can start to trade with more confidence and clarity.
Exactly, and that's the essence of Douglas's message in Chapter 7. It's about developing a probabilistic mindset that allows us to navigate the market's inherent randomness with grace and resilience. It's not easy, but it's incredibly rewarding.
This has been an incredibly insightful conversation. So what does this all mean for the listener, the trader who's trying to implement these principles in their own trading? What are some key takeaways they can walk away with?
Yeah, it feels like the biggest takeaway here is that shift in perspective that you mentioned, moving away from trying to predict specific outcomes and instead focusing on consistently playing the probabilities in our favor.
It's a fundamental shift, for sure. Recognizing that in trading, we're dealing with probabilities, not certainties, embracing that uncertainty, except we can't control every outcome, and really focusing on what we can control, our process, our risk management, our mindset.
And this is where I think a lot of traders get stuck, right? We're naturally drawn to wanting to be right, wanting to predict the market's every move, especially when there's money on the line. Absolutely, it's a natural human tendency. But the irony is that by surrendering to the uncertainty, accepting that we don't have all the answers, we actually gain a deeper sense of control. Not control over the market, but control over ourselves, our actions, our reactions.
It's like we're letting go of the illusion of control and embracing the reality of probability. And in that surrender, we find a more grounded, more sustainable way to approach trading.
That's a great way to put it. And this shift allows us to trade with more freedom, more flexibility. We're not constantly fighting against the market, trying to force it to fit our predictions. We're aligning ourselves with its probabilistic nature.
So instead of being caught up in that emotional roller coaster of wins and losses, where every trade feels like a life or death struggle, we can develop a calmer, more detached perspective.
Exactly. That detachment is crucial because it allows us to make clear-headed decisions based on our trading plan system. Rather than reacting emotionally to every market fluctuation, we're not letting our fear or greed dictate our actions.
Which brings us back to something we touched on earlier, the importance of predefining our risk on every trade.
Absolutely. By setting our stop-loss levels in advance, we're acknowledging that we could be wrong, that the market might not move in the direction we expect. We're protecting ourselves from those catastrophic losses that can wipe out our accounts and derail our trading journey.
It's like we're creating a safety net, a buffer. That allows us to take calculated risks without putting our entire trading capital at stake.
That's a great analogy, and this is a core element of thinking in probabilities. We know going in that we can't win every trade. Losses are inevitable, so we manage them effectively. We control our risk to stay in the game for the long run.
It's about playing the long game, not getting caught up in the short-term fluctuations.
Exactly. Now, managing risk is one side of the coin. The other side, of course, is managing our profits. And thinking in probabilities influences our approach here as well. Well, just as we need to accept losses as part of the game, we also need to accept that we can't win every trade indefinitely. We need to have a clear exit strategy, a plan for taking profits. And we need the discipline to stick to it, even when we're feeling tempted to get greedy.
Right. It's easy to get caught up in the euphoria of a winning streak, to start thinking we're invincible.
Yeah.
But the market has a way of humbling us, doesn't it?
It always does. And that's why having a predefined plan for taking profits is so important. It helps us avoid those emotional decisions that can lead to giving back our hard-earned gains.
So it's about having the discipline to stick to our plan, to execute our system, even when our emotions are telling us to do something else.
Exactly. And that discipline comes from understanding and internalizing the nature of probabilities. We know that even with a solid edge, there's always a chance the market could turn against us. We're not trying to outsmart the market. We're playing the odds, playing the probabilities over time.
It all comes back to that core idea. Focusing on the process, not the outcome. Consistently executing our trading plan, regardless of whether individual trades are winning or losing.
You've got it. By focusing on the process, we shift our attention away from what we can't control, the market's short-term movements, and toward what we can control, our own actions, our own behavior.
This has been a truly illuminating conversation. I feel like we've unpacked some really powerful concepts here.
I agree, and I hope it's been helpful for our listeners.
To wrap things up, I'd like to leave everyone with a question to ponder. If you truly embraced the randomness of the market, if you truly believe that anything can happen, how would that change your approach to trading? What emotional burdens could you release? What new possibilities could you open yourself up to?
That's a great question to reflect on. It gets to the heart of what Mark Douglas is trying to convey in Trading in the Zone. Developing a mindset that allows us to navigate the uncertainties of the market, with clarity, confidence, and a sense of peace.
And we encourage everyone to revisit Chapter 7 and explore how these principles can transform your trading experience. Until next time, happy trading, everyone.